Over shorter time frames, investing in emerging market stocks can seem fairly disappointing. Then again, during other periods, shares of companies based in these so-called developing countries look like no-brainers. They beat the pants off developed markets, whether in Europe, Asia, or the US. The key here is patience, says investment strategist Michael Humbert of Dimensional Fund Advisors. Hi, Michael. Thanks for joining us today.
Thanks for having me, Murray.
So you think taking the long view is essential to investing in emerging markets, correct?
Absolutely. We think taking the long view is helpful in all markets, but particularly so in emerging markets as they have unique costs and frictions associated with them. And so investors who can afford to take the long view, which is most of us, if we're being honest, are better served when they do so.
How does DFA put together its emerging markets funds, and how do you evaluate weightings of different countries?
Absolutely. So we're going to apply our same one investment philosophy that we use in our developed markets, the same to our emerging markets as well. So we're going to incorporate prices into our process and target securities with higher expected return. Those are going to be those smaller market capitalizations, lower relative prices, and higher profitability. We're going to apply that same philosophy to emerging markets. And in terms of country weight, we're going to go country by country and make sure that we build up the eligible universe within that country so that we compare apples to apples across emerging markets opportunity sets.
Yeah. And I guess the ride can be bumpy over the short term, correct?
Oh, absolutely. Equities are a volatile class. Equities themselves are inherently volatile. I think that they reflect that we live in an uncertain world, and emerging markets are no stranger to that volatility as well.
Yeah, I think a good example recently is Turkey, which had extreme underperformance in as recently as 2021, but then outperformed most other emerging markets in 2022.
Turkey had a great return in 2022 relative to the rest of the emerging markets landscape and the rest of the global opportunity set as well. And it's not uncommon, though. We see every year a wide dispersion and volatility on a country-by-country basis within emerging markets. We observe a couple things. One, there's no consistent out or underperformer, right? We tend to see, if we listed the emerging market countries, top to bottom, top performer, bottom performer, year by year, there's no discernible pattern. You can't time which market you're going to enter into. So another reason to be better positioned with consistent approach throughout your emerging markets allocation. And we also observe that in emerging markets, the spread is a little bit wider than those relative to developed markets. So the top performer and the bottom performer, that spread is a little wider. That volatility can lead to some of the unpleasant investment experience that some people have if they decide to take extreme concentrations in one country or another. Maybe you catch a downswing, or maybe you miss a country like Turkey in 2022, which did have strong equity returns.
Yeah, and I think according to Dimensional's emerging markets universe, we're talking about 24 countries, over 7,000 securities. And it's kind of interesting. I was reading in one of your reports that at the beginning in 1990, emerging markets represented about 63 billion in assets, and by the end of 2021, it's over 10 trillion. So the growth story is still there.
It's a staggering evolution of emerging markets over that 30-year period that you just outlined, Murray. I mean, it really reflects a lot of different things, primarily the changing composition of emerging markets. In the 1990s, there were just a handful of eligible emerging market countries, and Mexico was one of the top ones. Now the top countries look a lot more like China, India, Korea, Taiwan. The emergence of these markets and their increased investability over time, a changing composition of emerging markets. You want a process that is connected to market capitalization weights, that is flexible in its approach, so you can capture that changing composition.
Yeah, it's interesting. Emerging markets represented less than 13% of global markets free float adjusted market capitalization in 20 years ago. Measured by gross domestic product, emerging market share increased to close to 40% today. Is that the sort of growth story you're talking about?
I think you can measure the growth of emerging markets in a lot of different ways, and that gives you confidence in the story that's happened over the past 30 years. Importantly, I think the conclusion is the same. Whether I look at its emerging markets share of gross domestic product globally, or if I look at their market capitalization weight, the opportunity set there, the opportunity set in emerging markets is a deep and wide category to pursue. So if I think about emerging markets in terms of that 13% number that you quoted, that's a 13% of global market capitalization. That's a significant portion of the market to ignore if I can access it in a cost-effective way, which you can using many strategies, including dimensional strategies.
Interestingly, also from another one of your reports, the 5 largest countries in terms of market capitalization comprised approximately 3/4 emerging markets. Much attention is paid to the growth of China over the past decade, which represented 28% of the emerging markets universe early 2022. What about China's story? How much does that make up of your funds, and how do you straddle that where it's so concentrated at the top?
So we're going to, in our strategies, we're going to maintain that linked market capitalization weights. So the 28% number you quoted for China, we're going to be roughly in line with that, 25, 30%, depending on market movements of the day. And we're going to be roughly in line with market capitalization weights for other countries as well. We believe in doing so, I should say, because prices reflect in aggregate all investors' expectations for the future. They are ever forward-looking. And so they're our best model for understanding the go-forward understanding of the world. 30 years ago, it would have been hard to predict the rise of some of these countries, right? We don't know what's going to happen. And so maintaining that linked market capitalization weights gives us a few advantages in terms of producing more reliable outcomes for the end investor.
Yeah, I was just going to say, interestingly enough, China's weight of the global market is less than 4%. So that kind of puts things in perspective, doesn't it?
I was just going to offer that thought, Murray. Many investors are not 100% emerging markets. Many investors are not 28% allocated to China or whatever the number might be at that particular point in time. Many investors' opportunity set is global. So the U.S. is 60% of your global opportunity set using that same approach we took earlier as the percent of free flow market capitalization. You can get a similar concentration just by taking the top 10 or 15 U.S. stocks in terms of their market capitalization relative to entire countries. So we believe that the best mitigant for that concentration risk in a globally diversified portfolio is broad diversification. It reduces your idiosyncratic risk, and it helps produce more reliable outcomes, particularly if you have a flexible approach and if you implement your investment philosophy in a flexible way.
Okay, thank you very much, Michael.
Thank you, Murray.